I'm watching oil, and if oil isn't surging, then I think it just means that the risk of the straits being closed is lower.
According to Tom Lee's theory, the fact that the war with Iran didn't cause a black swan is actually positive for markets. Stay until the end of this video to find exactly why, and don't forget to like and subscribe to the channel. And now, let's jump right into it with this video from Tom Lee.
Welcome back. Stocks near some session highs. Every sector currently green except energy, led by consumer discretionary this morning. Joining us here at Post 9 is Tom Lee, Fundstrat Global Advisors, Head of Research, and Fundstrat Capital Chief Investment Officer, also a CNBC contributor. Tom, it's good to have you. Welcome. Talk about confounding expectations, wouldn't you say? What do you make of this morning's action?
Well, in some ways it's not a surprise because, as you know, like Art Cashin had the adage, sell the buildup, buy the invasion. And I think today is an example of that markets were kind of already nervous and anxious, and we've already saw de-risking, and the VIX was already elevated. So I think in some ways this is probably pretty typical.
Does it change your call for the rest of the year at all? And you think it displaces any other priorities or has any effect on bill passage or how that might get constructed?
In some ways, it actually strengthens the case for stocks to do better into year-end, because at the start of this year, we would have said U.S. bombing a nuclear facility is a black swan. Oil would be 120. Stocks should be down 10%. And then we have the event, and oil is not really surging, and stocks are up. So I'd almost say that you've put another stress test into the market. We've seen it pass it, and I think it means stocks should do pretty well into year-end.
Do you think Hormuz remains a risk?
I do, but, Brian Sullivan was off camera was mentioning a lot of strategic reasons why that may not be the case. I'm sure he's going to have his views, but I would say I'm watching oil, and if oil isn't surging, then I think it just means that the risk of the straits being closed is lower.
I guess when you think about the impact for U.S. stocks and bonds and the dollar, it comes down to growth and inflation expectations. And the key, Tom, is whether either of those things have changed in light of recent geopolitical events.
Yeah, and as you know, core CPI doesn't include energy. And as you know, when the ECB looks at core inflation, they exclude housing. Housing is not part of ECB's core CPI, and they're cutting. If you calculated U.S. CPI on the same exact basis, it's lower than Europe. So I do think there should be a dovish tilt towards the Fed, or that's the upside opportunity into year-end as well.
Tom, there seems to be a speculative nature to the market that's creeping in again. I wonder if it's a concern. And when I say that, I'm talking about the reception of some of the IPOs. I mean, granted, very well received, but Circle's now got a $62 billion market value. CoreWeave, almost $90 billion. You got a lot of SPACs coming back. I don't know if you've seen it.
Yeah.
Even Chamath is coming back with some SPACs. Any concern to you or no?
It is. I mean, those are echoes of 2021, which is some stocks get fantastically bizarre valuations, and I'm not naming any. And
you want to name some?
And then there is signs of speculation. And but the one thing that was true in 2021 that's not true now is when I meet with fund managers, in 2021 they said there was no stock they could buy because everything was expensive. That's actually not true anymore. Now the people I talk to are saying, look, the numbers have been better and numbers are going up, but the macro is making them uncertain. So there's actually a lot less risk taking by institutional investors.
So to the extent a speculative part of the market is something you monitor, it's not hitting a level that is that concerning to you.
Yeah, I mean, to me, David, it's the sign that the cohort that is speculating are the ones that bought the dip in April. As you know, it was retail, the Robinhood community, that was buying in April when institutions were selling and raising cash, and high net worth was raising cash. So it's the same crew now that is buying, the circles at one times assets under management, which is tremendous. But it's not speculation to me yet, because I'd say high net worth is not really that invested, and institutions are still pretty cautious.
But what is the underlying view that you have that makes you bullish? Is it that the economy is hanging in? Is it that earnings are picking up?
Well,
what's the fundamental reason?
I think when we look at macro, on the margin, things are better. We have better visibility on tariffs into 2026. We have regulation and tax, legislation visibility into 2026. I think the Fed is now being questioned about their unwillingness to cut. I mean, it was apparent 5 out of the 10 questions during the press conference were about that exact question. So there's a dovish Fed. I know consumers are overly cautious right now, but as you know, inflation expectations are far above CPI. That's a positive surprise if delivered inflation's lower. And then businesses have been really resilient. You know, I mean, I think actually the economy might be weakening, but earnings have been better. So overall, with all the cash on the sidelines, I mean, I would say we should be quite bullish, actually.
I actually agree with Tom Lee. I did expect oil prices to go substantially higher, and it didn't happen. And it looks like we have some sort of peace at the moment. That will only make the market more confident, and it's best to stay invested and not trying to time the market. And don't forget to like and subscribe to the channel. I'm a professional small business bookkeeper, so click the link below for a free consultation.